So we have a whole chapter on investments. I guess the first question is, why would a company invest? And there's usually, different reasons for it. A lot of companies have cash flows that are high at one time of the year and low at another. Good management practice dictates that you do not just let cash sit idle. It should be working for you. So at the times when a company has surplus cash, they will usually invest them in some kind of stocks or debt investments to earn some dividend and interest revenue on them, and also to possibly get some capital gains. That's the old buy low, sell high. Managing extra cash, if that's your goal, we're going to account for that one way. Chances are you're going to want to buy something that you can readily sell. In other words, it has to be highly marketable. It can't be some obscure security. You're going to want something that's fairly safe because it's extra cash right now, but you're going to need it soon, so you don't want to blow it by losing it on some shaky investment. And so that's so you're looking for what they would call a highly liquid investment that has fairly low risk. So things that would qualify for that at various times would be things like treasury notes or treasury bills, certificates of deposit, corporate bonds, things that are not what they call volatile. And we generally will be using what's called the cost method to account for those. Companies may have just a surplus of cash that's ongoing, which they can put into more long-term investments. In that case, they may want to invest in solid companies that are just paying a good dividend, or bonds that are paying a good interest rate, which is hard to find right now. But this would be something where they could leave those funds there for the long term and just receive regular dividend payments every quarter or regular interest payments semi-annually. And that would become part of their cash flow planning. Okay, so that would be just, they'd have sort of regular streams of income. And in either event, the goal would be to buy low and sell high, because then you also get some capital gains. So with the strategic reasons, this is where you're buying enough of the company to have some influence over them. So far, for these, well, basically the first two reasons, capital gains is sort of that kind of goes with all of them. But for these two, we're going to be using the cost method to account for them because, they're really, we may not have a whole lot of influence over the company. And, when we get to the strategic reasons, that's where you've bought enough of the company to be able to not tell them what to do, but you've bought enough of the company so that you have enough shares of stock which vote to have some significant influence over that company, some of their decisions. In this case, we have what we call the equity method that will account for that. Okay, so these hopefully will start to make sense. So when a company buys, say, 20 to 25% or more of another company's stock, depending on other circumstances, they can have significant control over that company. Why do companies do this? Intel invests in technology companies, communication companies, a lot of it's supplier companies, manufacturing all around the world, because part of their big, their overall strategy is to control the tech market. And so they've invested billions in companies around the world, and they have influence over the operations of those companies. Coca-Cola owns 36% of the bottling company, Coca-Cola Enterprises. A lot of manufacturing companies will invest in their suppliers heavily so that they might get a little preferential treatment. If supplies run short, they might get theirs first because, well, we own 30% of your stock, you better take care of us. Pharmaceutical companies are always investing in small pharmaceutical companies to keep new product coming up through their pipelines rather than their competitors' pipelines. So there's a lot of strategic reasons that companies buy, a significant amount of the shares of another company. Once you get to the point where you own 51% of the other company's stock, then you control that company. You have enough votes to tell them what to do. And so when that is the case, I don't have that up here, but when that's the case, we file consolidated financial statements. And with the logic being that since you control them, you're pretty much responsible for, the amount of revenues and expenses that they generate. So you're going to consolidate the results, their operating results, with your financial statements. Is really the economic entity assumption at work. There's two parts to that. The first part is you keep the owner's transactions separate from the company transactions. But the other part of the economic entity assumption is that if this is your company here and you control all of these companies, if you own 51% or more of the stock of all of these companies, you are regarded as an economic entity. And so you're going to file your consolidated financial statements. Okay. All right. So, okay. So that would kind of wrap up the why, and next we'll move on to the accounting.